The Q4 earnings season has ramped up this past week, and we've seen a larger mix of Q4 earnings during that time. Investors continue, though, to be concerned with the interest rate outlook and how companies are getting along during higher tariffs, among other things. Our research director, Shiraz Mian's here to help fill in some of the blanks for us now. Shiraz, there's a lot riding on the earnings impact on stocks this time around because Wall Street is expecting a big year for corporate earnings. Would you agree?
Oh, absolutely. Yeah. No, this is the earnings backdrop for the market has been favorable and positive, and that's a big part of the positive momentum we have been seeing in the market. And 2026, the expectations is for we had all 16 sectors expected to have positive earnings growth till yesterday. In fact, energy just modestly turned negative, but still having so many sectors expected to have positive earnings growth is pretty impressive. So a lot is riding on the earnings outlook.
So, in view of the earnings growth that's expected, how closely watched has corporate guidance been?
Oh, its guidance is always the most important part of every quarterly earnings announcement. This is even more critical and important at this stage, Terry. And the reason for that is that, as you and our audience knows, there's so many macro uncertainties weighing on the market and on the outlook for earnings and the economy. So it's the guidance that gives you some visibility in that uncertain backdrop. So, as you would recall from my earnings commentary, the revisions trend has been positive for some time now. Definitely the last couple of quarters, and it's critical for that favorable revisions trend to remain in place, and that's where the guidance question comes in. So, the positive outlook we have for earnings for 2026 as a whole, for that to be sustained, we need positive earnings commentary and guidance from management teams.
All right, what does the scorecard look like at this point?
So, including all of this morning's results, Terry, we now have 143 S&P 500 companies have reported results, or a little over 28% of the index members. Earnings are now up 14% year over year. Revenues are up 8.3%. 76.9% are beating EPS estimates, and 55.2% are beating revenue estimates. So a pretty strong showing.
So overall, what does that beat miss ratio look like?
So the beats ratios are tracking a bit on the lighter side. The way the 76.9% beats ratio for the on the EPS side for Q4. This is below the 80% average that we have been seeing for this same group of companies over the preceding 20 quarters, so the last 5 years. On the revenue side, the current 64.3% beats percentage compares to a 20-quarter average for this group of 68.4%. So both EPS and revenue beats percentages, it's fair to say at this stage, are below average.
And as we sit here and talk on January 29th, what does the margin picture look like?
So margins are under pressure, Terry. There's a host of factors, but they are expanding. expanding relative to the preceding quarter, meaning the third quarter of 2025, and also the year earlier quarter. So at this stage, for this group of 143 companies, we are showing net margins at 15.51%. In the preceding quarter, Q3, margins for the same group were 14.97%. And in the fourth quarter of 2024, year earlier quarter, 14.74%. So expanding, but not as much as many had hoped.
Some stocks, from what I've seen, like 3M, for example, beat expectations but then sank in subsequent trading on prospects due to tariffs. How much of a toll on earnings are tariffs taking?
So it's all over the place, Terry. The tariffs, as you would recall, uh, the worst numbers were penciled in post Liberation Day in April, uh, when everybody assumed that this will be a huge hit to earnings and margins and even the economy. The actual picture turned out to be somewhat better than those originally announced rates. A big reason for that was that the actual tariffs have been a function of the bilateral negotiations between the U.S. government and that specific market, European or Asian market or Latin American. So the actually levied tariffs, to the extent that a deal has been announced, have proved to be smaller than what we had seen. That said, there's still a bigger headwind compared to what was expected at the beginning of 2025. So the 3M is a good example. You mentioned 3M has had a mixed effect from tariffs post April last year. They shared a much bigger hit to margins and earnings as a result of tariffs. They improved that subsequently. And in this Q4 earnings release as well, they noted that the tariffs, particularly the European tariffs, will be a headwind for margins and profits, and they are not alone. We have seen McCormick, Levi's, Procter and Gamble, uh, just to name some of the companies that reported in recent days, cite tariffs as a headwind for their margins and earnings.
What about the tech earnings? Tech companies reported this week, so what's going on there, especially with the Mag 7? Are corporate AI spending plans still a big investor concern?
It is, but as you know, Terry, the Mag 7 companies, the big mega cap tech players, have been in the forefront of spending huge sums on AI infrastructure. And that remains to be the case this time, too. We saw Meta and Microsoft report results already. The market loves the Meta numbers, not so much Microsoft. But the year over year growth numbers are in line with the very strong growth numbers we have been seeing from the Meg Sevens all along. For the tech sector as a whole, we now have a quarter of the tech results from S&P 500 members, and it's a very strong showing. 25.4% earnings growth, 15.8% revenue growth. 90.9% of these companies are beating EPS estimates, and 77.3% of these companies are beating revenue estimates. So all along, a pretty strong showing from both the tech as well as the Mag Sevens.
And you mentioned earlier estimates have been rising. Is there any reason at this point to think estimates are too high, especially for the second half of the year?
So that is the big question, Terry, and that's tied to uh, the comment you made earlier about guidance. 2026, the expectation is, as I noted earlier, that 15 of the 16 ZAC sectors will have positive earnings growth. It was 16. All 16 sectors were earlier expected to have positive earnings growth, and this would have been the first time since 2018. So a pretty strong earnings outlook. Now, to the extent that one will have any skepticism about this earnings outlook, that has to be a function of your macroeconomic outlook. If you see the outlook for the economy being somewhat iffy and uncertain and problematic, then you will have less confidence in this very positive earnings outlook. I find myself as very confident in the earnings outlook. In fact, I think this positive revisions trend that you referred to is very much sustainable and should start improving. In fact, I'm starting to see that some of the economically sensitive parts of the market are starting to see positive estimate revisions. So I remain optimistic in my outlook.
All right, want to remind everybody that they can always see your written earnings commentary right on our homepage at Zacks.com. With Shiraz Mian, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.